Welcome to the Daily Update. This is Being Prepared Monday, April 18th, where we'll look at the action in the market today and then see how things look for Tuesday, April 19th. And it was really a pretty sleepy day. A little bit up, a little bit down. By the time everything was said and done, we pretty much got back to where we started. We were just about at the unchanged level. So it really wasn't all that exciting of a day. If anything, our indicators have turned even a little bit more negative right now because we were in a negative trend anyway. So with a lack of buying, we saw just a continuation of the weakness that we've been seeing. So we had a flat to higher open. We kind of gyrated around right at the open, which is not strange for a Monday, especially after a 3-day weekend. You see a lot of buying coming into the market. People that don't really care what happens intraday. Maybe they're just adding to their Roth IRA or adding to their investments and their dollar cost averaging. And those orders get executed. And then once that settles down, then the market goes in whatever direction it's going to go. We did see after the open some selling that took prices actually negative. And then the dip buyers came in and tried to take prices back positive. Then late in the day, we saw some more selling. And then right at the end, the last 10 minutes or so, we saw some buying. Right at the close, we ended up being down 0.02%. Some places where you might look up S&P 500 information might say unchanged. My chart says down 0.02%. We were below average with volume. You still have a lot of real indecisiveness right now. Our technicals are still pretty not positive. They're pretty negative overall currently, but hope is not lost. We still have some positive things in the background that might develop, but we better be careful or we might lose that if we don't take advantage of it. But at the same time, this positive backdrop that I've been talking about each day in the videos, that can take some time to develop. So just one day, 1 week, even a few weeks, that positive backdrop could be there, but the technical picture that was looking better, we're starting to lose that. That's more what I'm referring to. The big fixation now is also inflation and interest rates. Interest rates went up on Monday. That didn't really drive stocks lower, but it really kept them from going higher. And then oil really shot up, and once we start going up with oil too far, that tends to kind of freak the market out, at least these days. There was a time a few years ago when oil in the market would go up more or less hand in hand with each other. Well, now we're at the inflationary stage with oil prices and with all of the geopolitical things going on. That's more negative than positive right now. So the market's more in an inverse relationship with oil prices. And then, of course, all the different geopolitical concerns, Russia, Ukraine, the lockdowns in China, the supply chain issues. All these things are still in the background and ever changing, but we're mainly focusing on how do they impact prices in the stock market. So what are some comments that we can make after Monday? The technicals are still negative, and I'll go through the charts and show you what I mean by that. We could make a case for being short-term oversold. We were after Thursday's session. That was the last trading day last week. And since we didn't really go anywhere, we still have a bit of a short-term oversold condition now. And then rising interest rates, as they go up, this is really impacting growth stocks. And growth stocks are where the big movement price moves really go up or down in the stock market. And so if growth stocks are not going anywhere, then the indexes aren't really going anywhere either. Oil is rising that I talked about. The yield curves are not inverted, so I'm pretty much going to take that off right now, but I'll still watch those every day. And if we go back to an inverted type of scenario, I'll be talking about that again. And the dollar continues to be strong. We're still above 100 as far as the dollar index is concerned. There was one kind of minor economic report that came out on Monday. That was the NAHB Housing Market Index. It did decrease because we're seeing a bit of a slowdown in real estate, but that was as expected. They thought it was going to decline, and it did. So it didn't catch the market off guard. As far as our trend, the ADX is below 20 and we're chopping. We're going sideways as far as the trend. Our bias continues to be negative because we've had a number of negative days now in a row. And our momentum, we've also had even more days, 2, 3, 4, 5 days looking back. Overall, the momentum continues to be negative. During the day's session, as far as sentiment, we saw fear increase a little bit. It's still not getting all that extreme, but at least people are getting a little more afraid. We had been at 42, which was more neutral. Now we're sliding down a little bit. And what we really need to see is some kind of an extreme reading like we saw in the middle of March. And if we can get some kind of a bounce off that, that would be more positive. Just about the time everybody is convinced that the market's going lower, that's when we want to look for it to go higher. We're contrarian in that regard. But while it's in this mid-range here, we have to follow that. It doesn't mean that we always do the opposite of what this says. It just means we look to do the opposite when one reading is giving us an extreme reading, and then we want to look to do what everybody's not doing. And that turns out to be right a majority of the time. Here's the chart to show you where we've just dropping below 40 slightly. And because I have access to my other laptop now, you're probably seeing the screens probably look a little bit different. As far as the VIX, it did decline a little bit on a closing basis because we were pretty much unchanged. And then we closed kind of near the bottom of the VIX. As prices went down earlier in the day, the VIX really started to rise. But as we came back more to the unchanged level, the VIX started to go down as well. And then here's the VIX of the VIX, which also declined on a closing basis. That just means it really slowed down, and on the daily bar as well. And then we want to keep an eye on this Ulcer Index. It continues to climb as prices fall. We don't know when this is really going to roll over because there have been other times when it started to roll over and we were at a lower reading than we are now. We just want to keep an eye on this just to give us an idea of how much fear is in the market. As far as the sectors, since we technically had a down day, I sorted it according to the weakest sectors. Healthcare got hit the hardest with staples. Utilities took it down a little bit. As far as what was up, energy was up. That mainly had to do with oil. Financials were up, and tech was up slightly. So not a real decisive day by any means. And here is looking back to the all-time high where we have energies in the lead, then we have utilities, and then staples, which are starting to show some strength at times. And then real weak areas are tech is now in last place, communication, and discretionary. These have been more of our three growth culprits, if you will, that have been bringing the market down. And just looking at the tech sector, we still show continued weakness. We're below the moving average, and the moving average is flattening out and could be starting to roll over, even though tech was up 0.33%. And then the SOXX index, it had a pretty good day. It was up 1.76. This is the semiconductors inside of the tech sector. And it bounced, but really it's just kind of back within the range that it's been in lately. As far as inflation, the CRB was up 1.29%. So inflation keeps being an issue according to commodities. And then the CRB is really continuing to outperform the S&P 500, where here shows the S&P 500 is underperforming commodities. Then it didn't, because of the holiday on Friday, they didn't update things until after I had done the video. So I'm going to just briefly go through the current market valuation right now, where we really haven't changed much. They're still saying that we're fairly valued. And again, remember that with the yield curve here, they take the 10 to the 3 month, which has actually been going up. That curve has been widening, I guess you would say. And so it didn't invert like some of the other yield curves that we watch. So they're saying that we're fairly valued when compared to the yield curve. The Buffett indicator, after giving us a really high reading, is still overvalued. PE ratio, still overvalued, but not as high as it was. Interest rates, which again continue to be very low, they're more fairly valued. The margin debt has not been updated for a while, but we saw a real drop off in that. The mean reversion, again, it was more extreme positive, but we're still overvalued overall. So when they take all these things together, they come up with a fairly valued model. And that I think this is interesting, and I like that they've done this, but it's not that I hang my hat on what they say. This is just one of the different things that I look at. Technical alerts, at first we had the S&P go above 4,400. And let's see, I thought it crossed below later on, but well, guess it didn't. The NASDAQ went below 13.3, then went up to 13.4. Let's see, we had a bullish percent index crossover with the NYSE. It actually got above 50, so that could be positive. That's one of the broader markets that we look at. Now I have a chart that I'll show later. And then the dollar just continues to go higher and higher. It set another 52-week high on Monday. So let's look at the day. And this is going to look different. Where I get my charts is stockcharts.com. And they have this tool. It's called an ACP tool, Advanced Charting Program, I think. I don't know. And I kind of ignored that for a long time. I used their other kinds of charts forever and ever. Well, over the weekend, recently they've announced a lot of upgrades to this tool. And so I'm going to try using this. So it's going to look a little bit different than what you have probably seen before. And there's also a couple of new indicators. There's a bunch of new indicators that I have access to. Two of them I'll show you here, but the other two, I need to learn a little bit more about them and test them over a period of time. Where the two I'm going to show you, two or three, are pretty self-explanatory and just kind of fit into the indicators that we're already using. But way over here on the right is Monday's session, and this is what I'm talking about. We had what looked to be a positive open. We had a nice green bar. Well, then immediately we saw some selling, then we bounced back up, and we were just kind of treading water. Well, then selling came in, and this is when prices went negative. We never hit an S level. We got near it a little bit, but we never got there. This is S1 right here. This is one of the reasons why I want to use this charting software, because they keep these numbers on here, even if they're a little hard to see. Well, just when we got above S1, some buying came back in, but then we chopped sideways. Here's the late day selling I was talking about. And then right at the end, because each one of these bars is 10 minutes, we did see some selling come in. And so we ended up being pretty much unchanged on the day. And then here's our daily chart, which again just shows, okay, maybe we set a new low because we are negative overall, but really not much was decided by the time we closed. And then you can also see where volume was below average and really declined from last Thursday. We are currently 8.44% from the all-time high on the S&P. And then here's one of the new charts that they have as part of this charting tool. This is just how far are we away from the 200-day simple moving average. When we're above that, that means we're above, when it's green, that means that we are above the moving average. When it's red, that means we drop below. Way over here on the right, this just shows that we are below the 200-day moving average. So that feeds more into our long-term trend. And then I have a couple of moving averages up here. This is a 50 and a 200. And then this is some other kind of moving average that it's called an anchored. I'm testing it out just to see how it works. Now, I've also included a new section. Since right now we have such a battle between growth and value, I actually created a growth versus value section. So here, and these are pretty much the same charts. I just broken this into its own section. Little bit of a bounce in growth, little bit of a decline in volume or value. And then this is the growth index to value ratio, which had a little bit, just barely ticked up. Here is value to growth, where it has been doing more of a breakout lately, and this is the battle that we keep fighting. Here's the NASDAQ 100. It slightly outperformed the S&P 500. Here's the peer value index, which was up a little over 0.25%, and our growth index was unchanged overall. So here's the ratio between the two, which just shows how growth has really underperformed value. This shows also the ETFs of growth versus value and how it has underperformed. Then as far as our trend, here's the ADX. We're going sideways, but we're below 20. And we have a lot of these, the selling pressure ticked up a little bit, so that's more negative. We're seeing a decline with the green line right now, so that is also negative. So we are now in a sideways market, and we might be this way for quite a while as folks try to figure out what's going on. Our Arun, really, it hasn't changed. We're seeing a decrease in buying, but also a decrease in selling, so our oscillator has gone sideways. And then this is probably bigger than what you're used to seeing. Here's the decision point scorecard, which were more neutral on a short-term basis with their trend. We are in a downtrend, and we switched last week with their PMO signals, and then the other signals that you can clearly see here. As far as breadth, a bit of a decline based on price, a little bit of an advance based on volume. That's kind of interesting. A little bit of a positive divergence, you could say. And then our AD ratio, we're slightly below 0, so that is now negative. So we put that more into the negative category. New highs, new lows continues to trend lower. That's also negative. We're coming right down to the moving average as far as our accumulation or buying versus distribution or selling. And this just shows a bit of the real cluelessness that people have right now. They really don't know what to do. And by they, I mean investors. So our short-term charts were below the 20 period moving averages. Our moving average study shows a decline in the 20, decline in the 50, and a decline in the 200. Our moving average spaghetti tree, we're down below all of the moving averages that I plot here. So we've got a lot of ground to make up if we're going to bounce up out of this. MACD, negative and going down. The Swinland trading oscillator, and I've been actually misnaming that. It's not the short-term oscillator, it's the Swinland trading oscillator. I just use it more on a short-term basis. But we saw a decline based on price, but an advance based on volume. So there's two potentially positive divergences that we're seeing in some of the internals in the S&P, where volume went up even as price went down. McClellan oscillator continues to be negative. It's below 0. The Stochx RSI is pegged negative, as is the Williams percent R. And this is where we're getting some of our short-term oversold readings from. The Force Index bounced up just a little bit, but is still negative overall. Intermediate term, we're below the 50. And this is the big one, the red one right here. And people are saying, well, the 50 is acting as a resistance. Well, we never really got up to that. So that's kind of stretching it, in my opinion, that the 50 acted as resistance on Monday. Then our PMO, negative, also negative based on price and volume. Our PMO study shows a decline in those that are rising, those that are giving buy signals, and a decline in those that are above 0 to slightly flat. BPI continues to decline. And here's the longer term chart of the BPI. Our rainbow, we're coming down well into and even below parts of the rainbow. And then here's another area where we get some of the short-term oversold condition. The stochastics, extreme negative. Intermediate term, extreme negative and declining with the full stochastics. The summation index continues to go lower based on price and volume. All of our momentum oscillators are negative. CCI, extreme negative in the 14, also getting extreme negative with the 20 period calculation. The vortex, buying is going up, selling is going down, so we are negative. RSI, below 50 and pretty much flat with both of these, but that's negative overall. Then here's another new indicator. This is called the balance of power. And very simply, if we're above this dotted line, that means buyers are in control. If we're below this dotted line, that means sellers are in control. And this acts as a sort of oscillator. So we can keep an eye on this. We can look for divergences, whether they're negative or positive, just to see if this will help us out in trying to figure out what's happening in the market. But this is currently negative and declining. Here's another one called the Connors RSI, a little different take on the relative strength index. It actually advanced a little bit on Monday. And again, this is a newer indicator to me, so I'm familiar with the methodology, but really what we're looking for are extreme readings, whether it gets extreme positive or negative, and then if we're above or below this dash line, kind of is the line between positive and negative. Our trading systems, Elder, is still negative, as it is with the SPY. And our SAR continues to be negative with the dots above. Our different charts, Heiken Ashi, negative. Kegi, negative. Renko, negative. Three-line break, negative. Equivolume, lots of red candles with a declining ease of movement indicator. Point and figure, no change, but negative overall. It's giving us a high pole warning. That's the same warning that was generated last week, but not enough price movement has occurred for anything new to be drawn in this chart. Long term, we're below the 200-day moving average with our arithmetic scale and our logarithmic scale, which they're always identical. It's just how they look on the chart is the difference. The mega stocks were pretty much unchanged, but they're showing a lot of weakness after a recent death cross. And then our special K is looking more and more negative. It is also starting to roll over, and that's longer term. Then our moving average study, a decline in the 50, a decline in the 150, little bit of a decline to almost flat with the 200. Fibonacci, we're dropping down below the 38.2% retracement with the S&P. As far as the broad market, here's the S&P. Here, mid caps are still more sideways. Small caps are also more sideways. And the Dow Jones Composite right on the moving averages. You can't get more indecisive than this. I mean, yes, you can, but this just shows how when you take the Dow, the trannies, and the utilities, as strong as the utilities have been, but as weak as the trannies have been, and the Dow hasn't really been moving all that much, to end up right here on these moving averages is not necessarily a surprise. And then here is some Dow Theory. At a little bit of a decline in the Dow, the trannies, after just getting hammered, bounced back up but did decline a bit on Monday. And utilities were down slightly on Monday, but they've been performing really well in 2022. FANG stocks were actually up 0.25%, but still have a lot of damage left to repair. ARC was down 2.78%, so the market didn't like what Cathie Wood is trying to do there, at least on Monday. And here's the Dow, where it's looking a little more positive. We're still above the 50-period moving average. We're still above the pivot. But we had a recent death cross here. But it just shows that the Dow has really been sideways overall. But there is some positive things we can take from this chart. And then here is the Elder Impulse system with the diamonds. It is negative. Small caps pretty much going sideways and below both moving averages, still above S1, so that could be seen as somewhat positive. And then mid caps going sideways, below the pivot, below both moving averages. That's more negative. The NASDAQ fell a little bit, was virtually unchanged below both moving averages and below the pivot. Still have quite a ways to go if we are going to go to S1. NASDAQ 100, it was actually up a little bit, but below the moving averages, below the pivot, and a long ways to go to S1. Then here's the Vixen. Just shows that it spiked up a little bit on Monday, but then closed a lot lower as the NASDAQ the NASDAQ 100 showed some improvement later in the day. Here's the Elder Impulse system for the Qs. It's negative. NYSE, this is also a little bit more positive, where we're still above the pivot. We're above the 50 period. We're right on the 50 period moving average, but we had a death cross not too long ago. But so far, this broader based index is holding support. The S&P 100 outperformed the S&P 500 slightly. And here's another broad base. We're right on the pivot to a little bit below. This is another with the Wilshire. We want this to hold up for the whole market to at least give us some positive things to look at. If we really start to see this and the NYSE break down, that could portend to a lot more negative downward movement. Internationally, China's starting to roll over a little bit, and all of the other world indexes that we look at are starting, if they haven't already, to go negative. All stocks also showing a decline below the moving average and just not looking very healthy right now. Here's our non-US index. It was up a little bit. And then here's the dollar, which just keeps going higher and higher here. This is the daily chart. This is the beginning of the weekly chart, which we'll redraw every day this week. Oil, this is what I'm talking about, where it was up 0.62%, and people were using this as an excuse. Well, we weren't up all that much. So this is why the markets can use anything at any time as an excuse to do anything. But that was cited as one of the concerns on Monday. And gold was up a little over 0.5%, but we've kind of seen this before here. Here's the gold ETF. It was up only 0.33%. And here's the long-term view of the gold ETF. Here's silver. Also, it was up, as far as the ETF is concerned, almost 1%, even though it opened and then went down the rest of the day. And here's the longer-term view of silver. And then Bitcoin actually fell under 40. I didn't check it before I started recording. It's like, okay, are we going to see some buyers come in and take prices back above 40, or should we look at things rolling over down into the low 30s? As far as bonds, here is the chart. This just shows, and I'm probably not going to show this again after today. This just shows how our different yield curves have been behaving, where they're all back positive now. And then looking at the fib retracement, we've gone above the 61.8% retracement with the 30-year yield. We're getting really close to 3%. And if we do hit 3%, you can pretty much expect the financial media to, because that's a round number that they can talk about, and that might freak some people out. So you might want to keep an eye on that on Tuesday if interest rates keep going up. Then here's our yields across the board, where it's looking a little bit more normal now. And then internationally, this just shows how yields have been pretty much increasing overall. And then bonds have been decreasing. We have dropped through this support level and continue to go lower. We were down 0.3% with this index. And corporate bonds are also seeing a lot of price pressure right now. That means yields are going up, and we're at 3.88% with corporate bonds. Junk bonds were unchanged to slightly lower, with the current yield being at 6.36%. Our relative studies, this just shows how gold has been outperforming the S&P. Is this going to really break out, or is it going to come back down? And then this shows energy against the S&P. This is showing a pretty solid breakout, which is continuing. Here is energy against tech. So it just shows the energy has been really outperforming the tech sector. Here is growth against bond prices, where both have been really struggling. So that's why this chart, it's really not moving very much right now. Here is tech against the SPY. It just shows how tech has been underperforming the broader market. And here is tech against the 10-year Treasury. As interest rates go up, the tech sector goes down, and it was down on this ratio, 0.86%. This is the correlation that I've been talking about. The red dotted line is the 10-year yield, and it's been going up. The black line is the tech sector, and it's been going down. And the closer we get to a -1 means that there is an almost perfect inverse relationship. Now, it'll go away at some point, but right now it's what the markets are fixated on. And then here is the 10-year against tech, just showing how interest rates have really gone up much more than the tech sector has. Here is discretionary against staples. We saw a little bit of a bounce because staples didn't have a really good day. And the S&P has been really underperforming the rise in interest rates. Here's the low volatile stocks. They were actually down a little bit more. They were down 0.58% on a pretty slow day. But overall, the low volatile stocks have really been outperforming the rest of the S&P 500. And then this, I just want to keep an eye on this. This is where we have staples at the bottom, which at other times when it's spiked up, that has marked a bottom in the market. Well, we keep spiking up again. And so that's why I have a question mark here. We won't really know that at the time. We'll kind of have to look back on this. So I would just keep this in the back of your mind and just go, all right, I know that this is in play, but I can't really do any action based on this because about the time you think things have topped, then this thing spikes even more. So what's our outlook then for Tuesday? The technicals are negative, but we're showing some short-term oversold readings as we were after last Thursday. The markets remain trendless in an intermediate term range. That's gone on for pretty much all of 2022. There's the battle back and forth between growth and value. The big concern is interest rates going up and oil prices going up. And then the supply chain issues with some of the lockdowns that are happening in China. That can feed over into their economy, which can then feed over into the U.S. economy with problems that we're already having. The big economic report, it's not really big, but the main economic report coming out on Tuesday will be housing starts and building permits. So it's kind of a light week economically. And then geopolitically, we have the Russia-Ukraine situation, China and the supply chain issues, inflation and interest rates, oil. All of those things are what are weighing on the markets right now. So what are our scenarios here? For things to keep going down from here, they are supported by our technicals because our technicals are negative. If we see interest rates continue to go up, if we see anything that even hints at inflation getting worse, maybe somebody in the Fed will say something that spooks the markets out, that could cause things to go down. We're already in a negative picture already. Okay? So what could make things go up from here? Scenario number 2. We do have that positive backdrop after the yield curves reinvert. And again, I'm probably going to take this, I'll leave this on this chart, but I'm going to stop showing that chart because all the yield curves are now behaving the right way. And we could go up because short-term we're oversold, as we saw in our charts, with some of the moving averages and pivot points acting as either support or resistance. But where we're at right now is scenario number 3 with the ADX being below 20. It's going sideways to actually, and I kind of consider that more declining right now. And that produces a real slow price movement environment where we see things really choppy. And Monday was a good example of that. We treaded water for quite a while and just ended up where we started for the most part. So what's our conclusion? The S&P is negative overall. Short term, negative but oversold. Intermediate term, negative. Our oscillators are pretty much all negative now. There's still a few more that are showing some increased weakness. We're below the 50 period and 200 period simple moving average and exponential moving average. And then our longer term trend, The longer we stay under the 200, the more negative things become. So just get a glimpse at this really quick. These are just the different videos. I realize that this video is the full-length video, and it can be pretty long to watch, and a lot of you don't have time to do that. So right after I get done recording this, I record another snapshot video, which I try to keep around 10 minutes. It usually ends up being 10 to 12 to 13 minutes sometimes. But I'm trying to give you something of value that doesn't take you as much time to go through. And then you can watch that first. And then if you like what you hear or you're trying to make a decision, then you can come over and watch the full-length video. I did post the weekly video over the weekend. I'm going to wait till the end of the month to do the monthly videos. So that just gives you an idea of some of the other things that I do post. So thank you. Have a very good Tuesday, and I will prepare the next update after Tuesday's session.